Hey folks, you know, I was running an illustration for one of my investors the other day. They walked away from a deal over about $1,000 in asking price. Now they were a long-term, what they call buy and hold investor, meaning they were going to buy the property and they were going to rent it out, in their words, for 30 plus years. Okay, we got into negotiations and we started talking about, we started going back and forth on price, and we basically, the deal blew up over $1,000 difference in price. Okay, now the buyer's logic was, well, the home is new on the market, we'll just wait a little while and we'll take we'll make our offer again, after they've sat on the market and haven't sold for a while. My response was, hey, you got rates right now 4.5%, and this is not now, and I'm not quoting you rates, but they had a rate around 4.5% on this property, and I said, you probably want to take advantage of the rate. They decided not to. A couple weeks later, rates were 5%, which meant same price, around 200 grand, same loan amount anyways, around 200,000, was now going to be $60 more a month. That would obviously eat into their cash flow. But what I told them is, okay, so you're paying that $60 bucks a month, that's $720 a year. About a year and a half, you're going to eat, you've already eaten up your $1,000 that you walked away from a month ago, right? So I started looking at the math again. And I thought, okay, so at 4.5%, their payment was whatever, and at 5%, their payment was about 60 bucks more. And I was like, okay, at 4.5%, how much more of a house could they have bought? Like, what is the difference in payment, right? So I took the 5% payment, and basically what it got down to is that $60 at 4.5% would have bought them $11,000 more of house, right? Same cash flow, but $11,000 more in house, right? Not that big of a deal, right? Maybe not. But it's a very interesting thing to keep in mind about, taking advantage of rates while they're low. Because it could be the difference of, yes, $60 a month, that's $700 a year just in a half point in rate on a $200,000 loan. And that will vary on loan size, but still, it's something to keep in mind. Just a little tick up in rates can grossly affect what's going to happen. Now, if you look at that same situation 30 years down the road, it's, $20,000, $30,000. So just something to keep in mind, how rates might affect you. Thanks.